Hey, everybody. Welcome to the newest episode of the Mastering Commercial Real Estate podcast. I'm your host, Corey Mortensen, and today we have a very special guest. We have Daniel Reilly. Daniel, thank you so much for being a part of the show today.
Thanks, Corey. Glad to be here, my man.
Yeah, so Daniel and I met through the Michael Blanc Mastermind. I interviewed a mutual friend now and the latest guest, Teddy Molman, and really excited to have you on today and discuss more about commercial real estate, your investments, how you got into things. So let's just start it off with you introducing yourself and giving a short background into you and your business.
Sure thing. Again, Dan Reilly. Live at Newport Beach, California. Most importantly, husband and a father. That's the real purpose of life, raising two little kids and having a great relationship with my partner in life, Aaron. But on a professional level, I've been full-time commercial real estate investor for just about 2 years. We can get into some of the history there, but my active business, it's called Measured Capital. I have a business partner, and we organize and syndicate large multifamily deals, primarily in two markets that we can get into. But at the current date, we have 507 units that we've acquired since beginning about 18 months ago, and active pursuit of a few new deals. Great roster of investors that we're highly aligned with in terms of their goals and what we're doing, and a couple of good markets and operators with momentum. So that is the current business and how I'm involved in commercial real estate. It's all through multifamily.
Very good. So what were you doing before real estate?
Yeah, so I had a 18-year career in IT sales. So worked as an employee for a very small distributor, worked up to an executive position in that firm as it grew. And then it's just about 10 years ago now, I started my own business. So we had my daughter Claire was born on July 1st. And by, I think, August, I had left, my job, and by January the next year, it started a company. So that was a great run. We sold IT products, mainly data center products, to resellers. Building that business was a dream of mine. However, at the end of it, I now had a pretty significant overhead and a team that needed advice and leadership and consultation on a daily basis. And eventually got to the point where the business was sellable. So my partners made an offer to purchase my equity in that deal, which enabled me to have some freedom in my life and a little bit of a reset career-wise.
Well, that's perfect. That totally takes care of my next, which was what made you make the switch? And so maybe I'll twist that question up a little bit into what made you pivot from the exit of that company into commercial real estate. Did you do any single family before, or what got you to where you are now with real estate?
Yeah, absolutely. And I mean, the answer directly to your question is I experimented with a number of asset classes and ways of generating income over that 18-year period. And I decided that real estate was the best use of my time and the most levered way of doing that. So now for the story of it, while I was a commissioned salesperson and while I was a business owner, I was taking all of the free cash flow and investing that into real estate assets. So my entrance to real estate was horrible. I purchased a home in Southern California. This is a retail guy with a big income and 26 years old. Let's go buy a house. So we bought a house for $600,000 in Irvine, California in 2008. By the beginning of 2009, that home was worth less than $400,000, and I had a mortgage for $550 plus. So that's how I began real estate ownership. I don't know if you remember, but at the time, just turning in the keys was like the thing, just like, let the bank deal with it. So I definitely had that thought. I mean, as I was looking at working off $150,000 of underwater real estate, and mentors and coaches in my life said, no, you don't want to do that. You don't want to be bankrupt. You don't want to go with a default on your records. So they said, keep paying the mortgage. So we did, but then Corey, with the other idea there was, how am I going to make real estate positive again, right? Like, how can I deploy some capital to bring real estate into, because I see the news, people are buying stuff on discounts. Like, there's some good in this awful situation. And it came down to the fact that, okay, I have $30,000. I can either put it into my mortgage or pay down or try to improve my situation, or I discovered single family investing. So the quick story there is good friends of mine from college and high school started a turnkey real estate company when that wasn't a thing, by the way. 15, 18 years ago, no one was doing that. They were taking single family homes out of foreclosure, putting some rehab into them, putting a tenant in place, and then selling it to investors. I was a guinea pig for that. I was one of their first people to try that. Since then, they've sold, I think, well over 5,000 homes through that model. But it was a great experience. And I can summarize it to say the financial benefits of that first purchase were everything that they said it was going to be. It had cash flow day one, $300 of cash flow in place monthly from day one. It had principal pay down. It had tax, savings in terms of the depreciation, but the mortgage and everything. It had growth and equity. It had everything that it was supposed to have, right? So, Corey, to answer your question, now multiply that 10 years down the road, and I made a decision to liquidate that portfolio. I ended up buying to buy a single family home, which was a really strategic decision for me at the time. At the same time, I was packaging up and selling my business. Well, one required 10 years of blood, sweat, and tears, and I got X. And then one required an hour a month of checking an email, and I got X. So the decision was, let's go with option 2. And at that point, so it really was just, I ran 2 business models for 10 years. Both were lucrative. One took my soul from me, and one gave me all my time back.
Right. And so a lot of people, they consider real estate, especially multifamily real estate, a passive income asset for them in their management. Obviously, you can take a couple different seats with investing in real estate, but for people who consider real estate a passive investment, for you, how much time are you putting into your investments now and in your management, and give people an idea of what that looks like in terms of how much work it takes?
Yeah. So the way I like to look at that is that the capital is passive. The income and returns I'm getting from the capital that's deployed, that's passive income. Everything else is active as far as I'm concerned, because I have to work for it, right? How the IRS looks at it, that's one thing. But anything I'm doing on multifamily it's a full-time job, Corey. Let's be clear about that, right? I have more flexibility on when I want to work on it and how I want to work on it than in a corporate world, or where I'm responding to a customer base every day, right? In my past life, but it's still a very active business. As you may know, underwriting it is a full-time job. Going in and finishing deals and raising capital is a full-time job. Asset management and being on top of the property management as well. So we have a portfolio of 500 units. We've done a great job partnering strategically with asset managers and property managers who have skin in the game. So every deal I'm involved in, the folks that are on the ground running that property have significant skin in that, either because they put money in or because I found an incentive program for them. So they're highly aligned. So because of that, Corey, I'm fairly passive. However, I don't want to put any false hope out there. If you take down a 100-unit multifamily building, you're going to work. You're going to work a lot. Yeah,
absolutely. And you said it took 2 years to get to where you are now with the syndicating and multifamily style real estate investments. Well, that's awesome. That's no joke. 2 years in 500 units.
First purchase was in, it's right about a year, to be honest with you. The first purchase was in April of last year. And then our most recent acquisition was last month. So let's call it 13 months was, actively acquiring. Of course, now, Corey, it's a challenge in terms of today's markets, keeping that same pace. But yeah, it was a great first year getting into the business.
Yeah. Well, let's dive right into that. Your first deal, your first year. How big of a deal was your first property? What went into that? Tell us the story of that first acquisition.
So my story, and I want to be clear, Measured Capital is a partnership, a guy named Greg. So when I say I also would include him on that. But so I'll say we have a philosophy of really, we wanted to partner early on, right? So if we're going to take down an asset class, multi-million-dollar assets that we haven't personally managed this in the past, I want to drag off of other people's experience. So the first 2 deals, 150 plus doors, we were a co-GP of a more experienced operator who already had a deal either under contract or close to it. So the first deal was in Riverside, 16-unit deal that we turned into 17. That one was all the way through PSA, through inspection. They needed $1.5 million to close the deal. 2 weeks before closing date, they had less than 500 raised. I like the deal, I like the sponsor, and this is what I was going to do with my career. So I figured, what better opportunity than take this awesome deal that I'm going to put my own money into, right? I had decided to be an LP and help Max and the sponsors raise the whole, delta. This was right after I had sold the company, so I had some time on my hands, and I was spending a lot of time hanging out with cool people that I liked. So I started saying, hey, I'm literally, for a week straight, I made phone calls and I said, hey, I'm investing in this deal. Like I kind of mentioned, I might be. Here's the pro forma. If you have any interest in being involved, let me know. The story goes, Corey, 4 days later, I had over $1 million in verbal commits for that deal. And we funded the next week. So that's how we got started. That created some momentum around, hey, Dan can raise capital. Dan can identify a decent deal. Another deal in Waco, Texas came up much earlier in the process. They were still in kind of LOI, figuring it out stage. I flew out, interviewed the GP team, saw the property. It's still, to this day, I think, is the best acquisition I've been involved in. Purchase price to NOI is crazy. It's on the steps of Baylor University. I could sell that deal all day long. But anyways, those are the first 2 deals. I was a capital raiser, helping more experienced sponsors finish deals. And then we moved into being a lead sponsor after that.
So on that deal where you were inexperienced on the management side, you had some experience in real estate already, you found this deal, like the sponsor. I'll start with, how did you come to vet that sponsor? What made you like that deal? What made you like the sponsor?
So first, I've realized that, getting a look at someone's underwriting can tell me a lot, right? So a lot of these conversations ended very quickly when I get the underwriting and you look at exit cap rate, you look at revenue, growth of revenues, you look at kind of the projections of what they're doing. And in all of 30 seconds, I can just be like, nope, this is either a noob or this is someone who's just frothy in their expectations and doesn't agree with my thesis. So I can't move forward with you. For that deal specifically, the Waco deal we'll take as the example. I remember looking at this, I'm like, 1,200 in rents. The neighbors are getting 1,500, right? Your NOI in 3 years, you're gonna crush that, right? So that was my initial thing, was like, this is really conservative underwriting. Let me meet these people. Got on a long call. I mean, it was hours long, unfortunately for them. And I've been in a lot of partnerships in my life, and I know how partnerships blow up. So I asked a lot of questions, and it really comes down to an alignment of values and thesis and goals, Corey, right? So there's I'm looking for their character, I'm looking for their energy, and I'm looking for their competence. And I need to see, 10 out of 10s on all of those. I'll say I vetted 20 plus deals to get to those 2. And those 2 deals, had all those components.
So what made you confident in the underwriting? What was your experience in getting reps in with looking at deals, underwriting deals, and feeling confident in your underwriting? Because coming from a sales background is one thing, and it's great for being able to speak to people and network and things like that. But in terms of the hard skill of putting pen to paper and spending the time in an Excel sheet, where did you get your experience in that and the confidence to look at a deal, underwrite it, and give a green light to it?
Totally. It's a fantastic question, because I often look at new investors today and think about how big of a hill that is to climb, right? To become an experienced and confident underwriter. It's not an easy thing. So first was just education, right? The podcasts for years and seeing other people's models, then the official education of paying a bunch of money for Michael's program, getting a mentor. So I think part of the answer is that I saw 4 or 5 underwriting models, as we know, they're small pieces of software within Excel, and played around with those for a while, right before I got really serious about this, Corey. Then when I got the Blanc program, then I went really hardcore into it, and I did what I was supposed to do. I underwrote 100 deals just every day, took an OM, plugged it in, see what the outcome was, took an OM, plugged it in, see what the outcome was. Then I started having conversations with brokers. Then I started running my underwriting by other friends and peers in the industry. And then the other piece too is, like, I speak to any of the other business owners, entrepreneurs out there. If you've done a sales forecast, you've done underwriting on some levels, right? If you've looked at a budget, you've done underwriting on some levels. Like, there is some correlation to running other businesses and other P&Ls that relates into this, where underwriting is challenging. And as you know, is like, it's those terminal values, it's those exit cap rates, it's those assumptions on debt that change as you move through the deal. And that's where I call it the tea leaves, right? You got to kind of feel the tea leaves. Oh, I know where this is going. I'm going to put 6.25 on the interest rate, but I really think I can get 5.9. Those are kind of those advanced, advanced skills you build up. But the answer to your question is reps, 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 and feedback on those reps. Hey, mentor, here's my underwriting. Do you agree? Where am I off?
Yeah. And I think that's a great point that you made with just getting the reps. And you didn't have the experience with looking at the real estate deals, but you set a goal of 100 properties to underwrite. You took a look at them, you did the reps, you asked questions about them. And that's something similar that the last guest, Savannah Arroyo, her podcast isn't out yet, but she was a nurse. She was in the medical field and, no real estate or financial background, but in order to get the experience that she needed and the confidence that she needed to go out and talk about these investments confidently to people who are sophisticated and accredited investors, she just did reps. She made a goal of calling an insane amount of people and underwriting deals, taking a look at properties. And she just stayed committed to that one goal that was the most important thing. And so for anybody listening that's thinking of getting into this or needs to learn something that they're not very good at or they haven't had any experience, just set a goal to get those reps in, find somebody that you can bounce some questions off of, and just spend the time, stay committed to that goal.
Yeah, and I love the fact that you threw in making phone calls after that, because if you did 100 underwritings in your own room and never went anywhere, I don't know if you got better. It's when you make a phone call and say, hey, broker, I came up with 9 million because of this, right? And then they give you feedback. Hey, property manager, I can't, right? That's when it really starts to come in for you, when you start to follow up and get feedback on your conclusions.
Exactly. The feedback is the most important part, because if you're just doing reps with absolutely no idea about technique, that doesn't matter. You're not going to get anywhere doing that. You just spend a lot of time in Excel. And the Michael Blanc group that you and I are both involved in is really great at that, in looking at deals, underwriting deals as a group and bouncing ideas off of each other. The other group that I'm involved in is Real Estate Lab with David Tupin, who's another very successful real estate syndicator and entrepreneur. He was my first guest on the podcast, but we have weekly deal analysis calls where anybody can throw in a deal. We'll all underwrite it. He'll underwrite it with us together, and we can crank out 2 or 3 deals in an hour and take a look at them and get that feedback and get the reasoning from somebody who's got 100 million in acquisitions under their belt. And same with the Michael Blanc group. But going back to your experience with capital raising, and then now you're in a GP, a sponsor role, right?
Yes. Yep.
So what do you think is a preferred route in today's market, depending on experience? Would you go full capital raiser, look at the deals, allow other people to source, and maybe just niche down into that? Or would you say, I'm going to raise all the money for myself, I'm going to go take down my own deals, my own acquisitions?
Sure. So great question. And I think, of course, it depends on personality. However, I'll answer like this. I think starting as a capital raiser is a great way to do it, because again, you get that experience of that more experienced operator who's going to put down his own money, his reputation, some of his investors' money, right? That gives you the validation that the deal is pretty legit, right? If it makes sense to you and it makes sense to them, then that's a much better chance of being successful on that first deal. Because I'll say that one of the things that doesn't get spoken about a lot about capital raising is the responsibility that you're taking on, right? When I pull $1 million of money from my friends, I'm going to see them next week. I'm going to see them next year, right? So why I bring that up is to say, option 2 of going full cycle and being a lead sponsor, that would give me some trepidation, right? If the scenario is correct, that you've never done real estate, you've never done multifamily, you never sponsored a deal before, you never raised capital before, taking on that whole deal, I hope you get an amazing basis that has a lot of room for error, because you're going to make a lot of errors, right? That's just the reality of it. So I'll take it to our path is that we co-sponsored 2 deals, raised $3 million, saw multiple $1 million of rents collected, went on months worth of property management calls, saw the ups and downs, saw the rights and wrongs of the underwriting. Then in the middle of a meeting, I think it was in September, Greg looked over me and go, this thing would be a whole lot easier if we were just the lead sponsors, right? and he meant that to say, like, they're doing a good job, but like, I would have done this meeting in half the time and I would have made the decisions before I showed up. So can we just do our own deal now? So then I choose option 2, Corey, later, as I've already had some experience, already raised some capital, and got my feet wet.
Gotcha. So you guys are solely focused on your own acquisitions, your own capital raising, all in-house now?
We are. I put a caveat to that is that, again, we have strategic partnerships. So like in Des Moines, we have a group that we're buying with. We bought a property from them. We retained them as property managers, ended up having amazing connections and values aligned with those other sponsors. So now we've JV'd on a deal. We're JVing on another deal. So I'd still consider us, leading that deal, but at the same time, they have very much authority of that deal as well. So I guess you can splice the hair there as lead sponsor, full sponsor, GP, capital raiser, right? It all kind of depends.
Sure. So when you're looking at partnerships with other sponsors, other operators, how do you approach that in a negotiation standpoint, in splits, income operations, things like that? What is your mantra or approach or strategy?
I mean, for one, is that the impetus of the relationship and partnership has to be because of a leveraging of each other's strengths. Like leveraging each other's strengths. And I say that because a lot of business partnerships, and I've been involved in these, are made because of fear, because of scarcity, because I'm going to feel so much better if there's 3 other people in the room with me sharing this decision. I'm going to feel so much better when there's more people in this room sharing this risky thing we're doing. That is a terrible way to get into partnerships. And those partnerships basically always end in a negative outcome, because I've been there before. Where it makes sense is when there's strategic complementary strengths. For example, we live in Southern California. We own 400 apartments 400 doors in Des Moines, Iowa. That's a challenging flight, right? It takes hours. It only goes a couple of days a week for a direct flight. So we've partnered with someone who lives in Des Moines, owns 1,000 units in Des Moines, has 40 employees in Des Moines, has property management, has leasing offices, has all the infrastructure that we don't have. However, they're so busy running deals and managing properties that they literally sometimes run out of time to raise capital. I'm out raising capital every day. Perfect match, right? We agree on the strategy. We agree on the market. We agree on what we should be buying. They love to run them. We love to raise the money. Match made in heaven, right? So that is a great partnership. Similar thing in Jacksonville, those same guys that I bought those turnkey homes from, I'd partner with them on a property management level because they have a competitive advantage. They do it better than anyone else in the city. That's why I'd partner with them. Absent a big competitive advantage, then I would do it myself.
Gotcha. No, that's great advice. On your expectations for the market and what has changed in your underwriting, in your assumptions, what are you doing currently that you weren't doing maybe in the last year or two?
Sure. I mean, obviously, when I started into this, one of the challenges was how, again, I use the word frothy, just every deal is going to work out, right? This is in early 2021. It's like, don't worry about it. Rents are skyrocketing. Lost the lease, you'll make it up. I always struggle with that, Corey, right? And we pass on a lot of deals because of it. I think the reality is now things have come back down to in-place numbers, actual realistic cap rates, loans that you have to go out and qualify for now, right? So to be honest with you, I can't say a ton has changed in our underwriting, except that I'm less frustrating to brokers now because my requirements are also their requirements. Like, hey, no, I need the T12 and I actually need the real rent roll, not your judgment of what rent roll will be, but the real rent roll. So where is the market today and what's changed? In-place numbers matter because no bank is going to talk to you without in-place numbers. These frothy pro formas are no longer talked about. These 5%, 10% rent increases are no longer talked about. So that's what's big in terms of the assumptions. And then the other one is exit cap, right? It's always best practice to increase your cap rate, at exit. Now we're not doing the add a half point or add these basis points. Now it's just pick a really high number. So in Des Moines, we're underwriting 6.5 exit caps, right? And we wouldn't sell unless there's an opportune time. 6.5 cap isn't exactly an opportune time. So we're underwriting with kind of just truly conservative assumptions about where things are going to go, with the belief in my stomach that it's going to go back to 4s and 5s over the next 5 to 10 years. And if I want to sell, I'll sell at those moments. But that's the answer. Highly conservative adjustments to what was a very frothy and optimistic underwriting process.
Is there a situation that you would start to be more aggressive on your underwriting and start flipping back to maybe some more safe assumptions like in 2020, 2021, where people were assuming 4, 5, 6, 7, sometimes 10% rent growths on their pro formas? Is there, obviously we're not going to get that aggressive right
Yeah.
now or very quickly, but is there something in the market that's happening that might cause you to be a little more aggressive?
The only thing that can move the needle on a sell price right now is creative deal structuring and seller finance, right? I think right now we have to be basis buyers. We have to be low price buyers because we're in a discounting market. The only way I'm going to pay above an aggressive discount is if a seller comes in and offers 3.5% rate on a big portion of the balance in IO for a period of time, right? And we're actually making that offer frequently, by the way, Corey. And our last deal was accepted as a seller financing with terms that a bank would have laughed at. So that deal would not have happened if required on a bank, right? To underwrite and make happen. So I think right now that's the only thing that I can see that would get creative or push the price back up to some of the 2021 days was debt that makes it, that removes the risk, right? That gives you such a huge margin on your operations. You have years to grow the NOI.
Yeah, and that's the pivot that we've seen a lot of syndicators, entrepreneurs taking is you have to get creative when the market shifts like it has in the last year with creative financing situations like you mentioned. Are you able to go into detail about what those terms look like that you got?
Yeah, for sure. I mean, I think at the end of the day, it's better than a bank's going to offer. So we can start there. So if a bank is going to offer me, let's very ballpark, 65, 70 loan to value at a 6.5-ish rate, needing 1.25 or better DSCR, right? That's effectively what a community bank or Fannie is going to require today. Getting worse by the minute, right? So for a seller financing, I'm looking at 75 to 80, even higher. Our partner in Des Moines did a deal recently at 90% leverage seller finance. So it's certainly less down is the biggest thing. And then the rates. Yeah, I mean, again, the large deal that closed was at 5.5 rate. I think that's at the top of what seller financing should be. I think it can be in the 4s, the 3s, if a seller is motivated. I'll give you this as another rule of thumb. We've approached this a number of times with investors. They show you their NOI and what they made last year. Give you an example. They made $250,000 in cash flow from that building based on owning it. Sometimes when you do the math, take that 80% of the purchase price, put a 4% note on it, it creates more than what they were making owning the building. So our proposal to the seller isn't, hey, seller, finance me because the banks stink. No, it's you make 250, you can make 280 by giving us out finance. Plus, you'll get $1 million up front. Plus, you'll get 4 million, 5 million, 6 million in 5 years from now. Plus, you'll defer the taxes. Plus, you'll like, why wouldn't you do this, Mr. Seller? So that's how we're approaching it. It still doesn't work very frequently, but if the Fed does what we think it's going to do and banks continue to pull back, sellers are going to be forced to embrace this as a way to move product.
So when does a situation fit the bill for a seller finance?
When DSCR on a purchase price doesn't exceed 1.25. I mean, it's as simple as that, right? If we're trying to get reasonable leverage, the banks do not go past that. It is based on in-place numbers nowadays. So that reality of it is that's it. I mean, if you're trying to sell a building for more than 1.25, you're gonna have to get creative.
Gotcha. For newer investors that are getting started or early on in their career, what are some of the most common mistakes that new commercial real estate investors make, and how can they avoid them?
Yeah, I mean, I'll go from something that I did well. I didn't know I was doing it, but it was one of the best things that I've done, and it served me well. Was be investor first is the way I'm going to say that. So I'm very in tune with my investors and what their goals are, and I let their goals inform my thesis, and then my thesis informs my actions as a sponsor, right? So the opposite of that I think is very dangerous. We get into a room and we decide on what we're going to buy and what makes sense, and then we do the underwriting by ourselves in our own little private world, and then we come out and we decide we're going to go raise money for it. I think that's a really challenging way of going about it. You're probably going to get disappointed. So again, my advice is like, get out and talk about it. Go have meetings with investors, not just to raise money, but to get reality checks. Like people that invest in real estate. You don't realize it because you didn't ask them. Like I've been shocked. I have like 10% of my network owns dramatic amounts of real estate, right? So I've been able to pull from a lot of folks that I know that own multifamily, that own duplexes, that own large stuff out of state. Anyways, so I think one of the challenges and one of the mistakes that's made early on is trying to do it on your own and trying to kind of stay private and to yourself. I say get out there, relationship, mix it up. Measured Capital has one big rule for the sponsors and Greg and I, and it's ABR, always be raising. Every day, every hour, every meeting we're raising capital, right? I may not be aggressively asking you for capital because I don't do that, but I'm talking about it. I'm sharing my interest and my enthusiasm for it and how it's changing my life. And it just so happens that most people say, oh, I want to learn more about that.
So what is the expectation from investors? What are investors looking for most right now, especially when putting their money into passive real estate investments? Is it more a question of risk or is it return?
I believe the majority of the capital that has been pledged to our deals are interested in principal protection above all else. They're looking for a asset that will protect that capital for 5+ years, which is not guaranteed any way, shape, or form in a stock account, right? It could go down dramatically in a stock account. And that has a pretty darn good chance of having a great return, right? So I'm forecasting 15, 17% IRRs. I'm forecasting some cash flow throughout, and that's exciting. And without it, no one's going to say yes. But why does an individual decide to take $500,000 out of their personal stock account and move it over to this private investment in a working class apartment in Des Moines, Iowa? It's because they believe it's secure. They believe that asset is a safe, tangible place for that money to live. And then they look at our underwriting and saying, gee, this thing's going to generate some profits. I like my chances on that. So there's a good chance it'll have a good return. But I think it's protection first, avoiding risk first, and then outsized returns would be second.
Gotcha. And so when you're looking at your investments to pitch to investors, underwriting deals, talking about risk assessment, what are some of the red flags that you see in properties that you tend to stay away from? What is your plan for? Is it a value add? What are some of the approaches that you go to look for in deals and then stay away from in your findings of underwriting or whatever it may be?
Sure. I think there's a lot of criteria that location wise, asset class wise, size wise, that are just automatic. They don't fit our buy box. So we just immediately push them out. So it's like, I don't even think about it a lot of times, Corey, because it doesn't even get past that first filter. But once we're in there, we're value add investors. We're trying to create really high returns. We're trying to double money every 5 years or better. That's the goal of our investment and what we're trying to get done with that capital. So certainly we're looking for meat in the bone. And I'm trying to think of red flags that make me say, oh my gosh, no. Not necessarily, right? It really comes down to what the purchase price is, right? I had a customer of mine. I can summarize the whole answer to this. He used to say this all the time. This was back when I traded hard drives and central processing units. He used to be a stockbroker on the New York Stock Exchange on the floor. And he'd say, Dan, there's no such thing as bad merchandise. There's only bad prices. And I feel similar to that. Once you've hit my criteria, if it's in Des Moines, it's 100 units, it's on, it has all these criterias that I've asked for, and it's entered my criteria box. Now it's just a price thing, right? It's like, I don't want that at 90K a door, no way. But at 60K a door, I'll pay cash, right? So I think that really comes down to it. It's my red flags and my absolutes are A-class properties in Miami. That's a red flag and a no for me, right? But someone else could make a fortune on that. That's not what I'm investing in. So that's my red flag.
Gotcha. So we've talked about the nuts and bolts of the investments, taking a look at them. What are you doing to find these deals in the first place? Is it all brokers? Is it direct to seller, direct to owner, or a mix of both? Or what are you doing to find deals?
Yep. I mean, I think deal flow is well, certainly right now is the most challenging thing, right? I think when I entered the market, it was pretty easy to have your inbox full of deals, but right now it's a challenge, especially to get off market stuff. For us, we've decided to go full in on the broker relationships. I've always been a relationship guy, and I think I can earn trust. So we like to identify the two best brokers, highest volume brokers in each market that we're working on, and become their best friends. And that's really, the game. And I can say that I've seen that play out in a pretty powerful way. Because of course, Corey, I could market directly, I could mail, I can cold call. All those things work, by the way. They all work. But one thing that I've seen through our current partner in Des Moines, he's been in there for probably a decade, probably the most high volume buyer and seller for this type of asset class in that market. We've been in that market for 2 years. We go out and have coffee with the brokers all the time. We're on the phone with them all the time. We get some good feel of deal flow. On a monthly basis, our partner gets a phone call from the most powerful broker in town and goes, "Hey, remember that deal that we're shopping at 75K a door? If you make me an offer at 60K a door, I'll get it under contract today." You're like, "What? Like, what do you mean you got that offer?" And the point is, like, he is a proven buyer. He always goes through on what he says he's going to do. His buy box never changes. And when he says he's going to do it, he does it. So my lesson there is that, like, for anyone listening, is that, like, it's hard to be the most important guy in town in your first year, right? It's really challenging to be the hot chick there. But man, if you can close deals for 10 years and never let anybody down, your phone will ring every single day. And it won't be, "Hey, come check out this thing that the seller wants them to see." It's like, "I have a deal and it's a slam dunk. Will you just write me a piece of paper for it?" So that's kind of where we're going and where we've seen it, right? We've seen what happens when you do this well with brokers. And Corey, they spend their lives talking to sellers, right? If you're a commercial real estate broker, you wake up every day and you call sellers. So getting into the market, I'm like, "Oh, now I'm going to start cold calling the same guys that he already did. Nah, I'll just use his relationships." So
Yeah, it's so interesting to hear people's approach to off market versus broker relationships, and that's one of the points that really stands out to me is the people who go all in on the broker relationships really leverage that sector, that profession, because that's their whole job, is talking to owners, and you want to compete with them and give an offer that's less competitive than a listing price, from a broker. That's tough, especially if you're in a very saturated market, a top market. Those broker relationships can really come through in one way or another. And even if you are starting out, it's important to find some, and you may find people that you tell them honestly, say, "Hey, we're in our first year, first acquisition," and they may not give you the time of day, but there's brokers that will, and you spend time with them, you give them constant feedback on deals, even if they don't work. They appreciate that. That helps them with sellers. And we've mentioned this on other episodes, but I love hearing other people's approach to the deal sourcing. And I've been surprised at the amount of broker relation that people are more skewed to on the investing side. So interesting to know. Do you do any off market at all?
I mean, again, yes, but through brokers, right? I mean, there are true off markets, right? Again, it's not, once there's a document on it, it's no longer off market, right? But like, we've definitely gotten phone calls of like, "I just left a seller's coffee meeting. I have a T12, and he says if I give him $7 million in the next 48 hours, he'll lock it up." Like, those do happen. And again, I know other sponsors that have been in the market for 20 years that get that kind of phone call on a daily basis. "I got someone in trouble. It's exactly your perfect buy box. Will you please just write an OLI at this number?" That's where I'm trying to get to, where brokers are at that place, because then, there's no marketing engine. There's no Google ads and phone calls and talking to sellers and getting it. No, it is ready to go. And I've seen it and been part of those transactions. So I know it's possible.
Yeah, I love those fresh pipeline deals and getting the call on those. "Hey, we got this deal. We're ready to go check it out." I'm like, "I will get you an answer in 24 to 48 hours."
Exactly. And I want to echo too that you talked about value to the brokers. That's how it works. You have to provide them value, direct feedback. "I'd pay this." And then if you say, "I'd pay 72K a door," and they call you back in an hour and the seller says, "I'll take 72K a door," you better be ready to write an LOI, and you better be ready to turn that into a PSA, and you better be able to close in 45 days. The moment you don't, you stop getting the off-market phone calls.
Gotcha. So in terms of negotiating in the deals, you've got a deal, you've underwritten it, it looks great. You're going to get an LOI or PSA out and you're executed, or you're in the process of that. What have you seen lately in your negotiations to convince somebody to go under contract, get a lower purchase price successfully? What are some of the things that you do regularly in your negotiations, or what are some best practices and tips?
I think in terms of the process that we use to make offers is very collaborative. So I oftentimes make a video with my offers. I give it a rationale as to why I'm offering in a certain way, and I give a lot of personality to it. So my goal is there. I never want a response of like, here's the number of a counter. The responses to those will come back with stories. Well, they like this, but they think you're off on that, and they want to know about this, but what about that? So now I'm trying to create lots of different angles for me to work on, right? And lots of different levers we can pull as we move through the process. So I hope that answers your question to say I like to open up a lot of different topics and a lot of different ways of looking at this. Hey, interest rates are moving. So if you want to lock an interest rate with me, then we can lock the price. But otherwise, we kind of got to float on price. Agreed? Right? Hey, I saw this in your rent roll. Is that how you see it too? So, right, I like to plant a lot of those seeds early on, never saying that the seller's wrong or being too, aggressive or frothy, but simply saying, hey, notice that one. We'll come back to that one later. That served me well because then I'm never surprising the seller. Oh, hey, by the way, found this on the last minute. Plant those seeds early. Cats on the roof is what my partner Greg calls it. There's cats on the roof. We can hear them. We can hear them, crawling up there. Something's going to happen. Something bad's going to happen.
I haven't heard of that saying before.
Yeah.
So your team, you have you and your partner. Is it just you two? Do you have anybody helping with acquisitions, marketing, VAs? What does your team look like today?
In terms of measured capital, it is the two of us. And honestly, that is because both of us have come from big time jobs and big time teams. Greg had 30 or 40 people reporting to him. I had 20 plus. And maybe it's just a stage of life. We were looking for more freedom and agency in our time. So what we've done is instead looked at our individual deal teams. So for the Jefferson and Oaks, there's 3 people in Des Moines who are very much my teammates on that deal. For the Center in Waco, there's very much 4 people that are my partners on those deals. So I'm trying to look at it like that. As our overall portfolio grows, we're starting to see the need for that. However, we're doing our best to use software, automation. I hate to throw in AI, but yes, AI as a way to reduce workloads on us. We really like to see ours get to a couple thousand units under ownership before we hire any employees.
So what does your tech stack look like? Or what are some of the resources that you use on a day-to-day that have proven to be really useful for you?
Yeah, best thing we did, and it was just by default, we just needed a solution real quick, was it's called Sponsor Cloud now, Syndication Pro, just as a way to manage investors. So our first deal I did all DocuSigns and inside spreadsheets, a nightmare experience for my investors. I actually remember a guy called, his name's Sam, nice guy. Hey man, I believe in the project and you, but like, this was awful. Like, you got to improve this system, right? So quickly investigated that. So Syndication Pro is awesome because it puts everything you want in the deal, organizes all the money, tells the investor where it's at. We even do our distributions reporting through it. So that's been huge. We have a property managed effectively through Upfolio. Our strategic partners all have Upfolio. So I have 3 guest accounts to Upfolio that I manage through. ChatGPT is up on my screen every day for when I'm making decisions and having ideas and writing things and whatever else. Active Campaign is what we use to market to our investors with. And just productivity software after that. Pretty light still.
So what does an average day look like for you?
Yeah, I mean, no doubt every single day I want to be face-to-face with a potential investor. And that doesn't mean I'm like setting up an investor coffee per se. I'm just meeting with someone who's interesting and I want to connect with. And by default, they're accredited, right? They're in their 40s, they're successful, they own businesses, they're executives. I know they have the financial qualifications. So for sure, once a day, I want to have an intimate conversation with someone about investing as an LP, or about the topic of that. No doubt we want to be looking at a deal, updating a deal, talking to a broker about some kind of transaction, right? At least once a week, we'll have kind of a gloves off underwriting session. So that's kind of, Corey, once we have a deal we really like and are about to make a move on, you have that like 2-hour just challenge every single sell, make sure every single thing's locked in before you make that offer. So that happens probably once a week. And then when we get a deal into contract, then that's what we call our sprints, right? That's 21 days to raise a couple $1 million and due diligence a large building. So we save some energy up for those sprints when they come up. But yeah, that's the general gist. Have a couple meetings around raising money, have a couple meetings around potential deals, and have a couple meetings around current deals. Yeah.
Perfect. And as we wrap up, if you could go back in time and give yourself a piece of advice, when would you go to and what would you say?
Wow. I would go to bigger is better. And I mean that in terms of talking to myself when I was making the move from triplex to 100 unit or from single family to multifamily. That was such a big mental hurdle to get through. And once I finally got there, it's easier. It's dramatically easier. I'd much rather talk to a commercial bank than someone writing a single family home. I'd much rather talk to a mortgage, or a commercial broker than a single family sales agent. All of it's better, right? So I guess just the lesson to myself is like, and the lesson to the audience is like, get out of the limiting beliefs that hold you back and scale up, not one, but like 5 levels, like quickly. Life's better over here.
Exactly. And that's the whole reason I'm focused on commercial and multifamily. And I think that's perfect advice. So where can people find out more about
on
you and where can they
LinkedIn,
connect with you?
Yeah, sorry, buddy. LinkedIn is my most active social. So Daniel Reilly with Measured Capital, you find me there. Measuredcapital.com is our site for investors that they can find out. And then additionally, Corey, I'm not ready to promote it fully, but there is a book on the way being edited. So within the next few months, we will be releasing the High Achievers Guide to Real Estate Investing, and those websites and URLs will promote it when it's ready. So
perfect. That sounds great. Dan,
awesome.
Thank you so much for being a guest today. I'm disappointed we have to end here. I've got so many questions still to ask you, but maybe we can get you on for a part 2. But thank you so much for being a part of the show today.
Thanks, Corey. Really enjoyed it, man.
All right. Thanks, everybody. This has been the latest episode of the Mastering Commercial Real Estate Podcast. I'm your host, Corey Mortensen, and this was Daniel Reilly. Thank you.